First fund was a $16 million fund.
So you were at UBS for
13 years, yeah.
13 years.
Every 3 months I had a different manager. Got to get exposure to the CEOs, to the low-level employees, and everyone in between. When I ultimately left UBS, I had spoken to thousands of people across venture capital and private equity. I was at a position where like, wait, I can leverage that to potentially start something on the private investing side. Is that right? The most important component of a company's success is...
My guest today is Abie J. Cohen, founder and managing partner at Center Street Partners, a New York-based venture capital firm. This episode leans a little bit more into the technical side of finance and venture capital, but in a way that's super eye-opening. We talked about what it really means to bet on the jockey, not the horse, how Abie raised his first $16 million fund with the founder of WhatsApp, and why most of the 5,000 pitches he's heard never turn into investments. We also got into how Center Street's new $60 million fund is shaking up the model by buying majority stakes in cash-generating businesses and layering in AI. I'm Victor Brackett. Momentum is where we dive deep into the stories behind business success. Guys, if you want to learn about how top investors really think about people, money, risk, you'll want to stick around until the end of this one. It was a really solid episode. Enjoy. Big thanks to Kosher Media for sponsoring this episode. More on them later. Abie J. Cohen, welcome to Momentum.
Thanks for having me, Victor.
You meet a lot of people, you interact with so many people, founders and executives and people who have founded startups, and which I think is very interesting, and we'll get to that in your entire career history. If I had to ask you in your own words, how do you explain what you do in the most impactful way possible? What would you say?
I invest in people. I seek out talent. And that doesn't even necessarily need to be business talent, but seek them out, see potential in them, and try to get a way to buy into what they're building. And it ultimately, or usually culminates in investing dollars out of a fund into an individual and their business endeavors, with their startup in some instances, but I invest in people. That's how I describe it.
What does it mean that you invest in people? Because most people would think you invest in companies.
Mm-hmm. Yeah. At the early stage of company building, especially in venture-backed companies, the most important component of, or the determinant of a company's success is the individual behind it.
Not the idea?
Not the idea. Absolutely not. I mean, people like to use that analogy of like betting on the jockey versus the horse or the track. We bet on jockeys. Most venture early stage investors bet on jockeys, and they'll tell you that companies that they thought were going to be great or ideas that they thought were going to be great end up turning out the opposite. And it all is, again, determinant of who the individual is, how much grit they have, how much earned insight they have into being able to build in the category that they're building in, how they've been able to, face obstacles and be resilient and overcome obstacles to be able to just get to the next step and get the momentum that they need to grow a company. So it absolutely comes down to the individuals.
So we'll get to your story in very shortly. We usually cover that in the beginning of the episode, but I want to ask you, just to build off of this conversation, how do you feel out an individual?
Yeah, that's a great question. We just try to spend as much time with them in person as possible, whether it's Zoom or actually one-on-one. That's really it. I mean, we do a bunch of reference checks. We try to get a sense of how they think around all sorts of different elements of both business and non-business, and try to get to the crux in short order of whether or not we feel like we can back them, whether they're high integrity and honest and have good values, of course, which is probably the hardest thing to get to. But we try to align on that level and get to the bottom of whether or not we feel like with their initiative, the momentum that they're putting on paper, the idea that they're putting on paper, that whether or not they can get to at least the next stage of funding. So
cool. Yeah. It's interesting, like betting on people, not companies. So taking me back to your earlier days, were you always entrepreneurial?
No, I would not classify myself as entrepreneurial, nor do I now classify myself as entrepreneurial, even though, it's all relative, right? I'm amongst dozens and dozens and dozens of entrepreneurs on a day in, day out basis. And I really don't call myself a founder by any means. The founders are the guys like you, the founders of businesses that are putting their neck out there and leaving money on the table from a corporate job to go start something, sacrificing family and the like. So
You did do that, though. You did do that.
in some respects, in hindsight, but again, it's all relative. So
Right.
I never thought myself as entrepreneurial. Went straight into corporate America right out of undergrad. I went to NYU Stern, and then I went to UBS for 13 years. So, I mean, I was a company man, moving up the ladder, looking for promotions. I went lateral a couple of times within the organization into different roles, which were, I would say, out of the box in terms of what those lateral moves were. And we moved from a training program into an equity derivative sales and trading program, which was very markets oriented and like where you watch the markets and sit behind 8 screens for 12 hours a day. And then I moved over into extremely client-facing role, like the complete opposite, something where I'd be out and about and try to have as many conversations, coffees, lunches, dinners with as many people as possible and try to build a network. So I guess in that regard, there was definitely some gumption for me to think like, okay, well, how do I need to build the next set of skills for me to ultimately continue to learn and continue to succeed in business. And I think maybe I'm entrepreneurial, open-minded to taking on new risks and doing different things.
Okay, so take me into when you first started college, NYU Stern. I'm actually starting there in 2 days. So take me into that. Did you know that you wanted to pursue a certain track?
Yeah, I definitely went down the finance track from the onset. I mean, I applied to undergrad business school, which we could talk about the positive and negatives of, and wanted to stay local in New York, mostly as a function of wanting to intern right out of the gate, and that facilitated that really easy. But yeah, finance was the track. I mean, 2007 is when I graduated. I entered class in 2003. I mean, the stock market was very popular at that point. There was a bull market. My dad also runs and ran a hedge fund for a very long time, came from the public markets. So we, just sort of grew up with the Wall Street Journal on the kitchen table. And that's what I was definitely attracted to. Never considered non-business as a pursuit, and it was always the finance track as opposed to marketing or management or anything that comes with Stern these days, which is a lot more diversified, I hear, than it used to be.
Right. I mean, I guess I'll
You can
find
be
out.
a computer science major in Stern, right?
True.
And you can do anything, right?
Right,
Obviously,
real
AI
estate,
is
right.
changing the game too with respect to how business is taught and learned. So, but I was going down like the pretty traditional sales and trading route, not even investment banking, sales and trading.
Got it. So, like from the onset, a lot of people are focused on investment banking.
Yeah.
What is sales and trading? What was that 10 years ago? 25, 50 years ago, I don't know, 50, but however many years ago, it was what it looked like in The Wolf of Wall Street,
Yeah.
right? Where you're sitting at a desk taking calls and stockbroking. So, like,
Yeah.
what is sales and trading in 2005, 2007?
Yeah. It's not too dissimilar, except I would like to say it's a lot quieter on a trading floor than what it was in Wolf of Wall Street. So big, huge trading floor, all sorts of different individuals, a lot of screens. And it wasn't only sales or traders on the trading floor. There were lawyers on the trading floor. There were managers on the trading floor. It sort of brought the whole organization in a hierarchical way to this open floor plan, which I think is like could be studied for whatever it's worth. We were predominantly creating financial products, they call them structured products, for clients of ours, clients of UBS's, to be able to buy. And these were derivative products. So these weren't necessarily stocks or bonds, but they would offer the client a return based on the performance of a stock or bond, but not directly. You didn't actually go out and put a stock or a bond into the product. You had an option or some sort of derivative that would return or yield based on the performance of that. So it's sort of
An option is a derivative of a stock performance.
an option is a derivative, yes,
Got
because
it.
it's not directly it's not a direct actual product.
It's affected by it, but it's not
Exactly, and anyone can create it, and anyone can buy and sell it and create a market for it. You don't have to be listed on the exchange. Like it's like almost sort of like a bookie in the gambling, right? They create this book of bets based on what football outcome is, but they're not determinant of what that football outcome is. They just have a book that can hopefully yield a positive return, irrespective of what that outcome is.
So you're creating what's called financial products for clients of the company. Let's say like people who, like clients of wealth managers at UBS, for example, to invest in. So when you first joined UBS, what did it look like? What was your job as like when you were a junior? Like a junior banker gets kicked around and bullied. Like was that your case?
Yeah, so I did some internships that were, grunt work, for lack of a better word, but I thought that was a good opportunity to just knock it out of the park in terms of what they would expect of you, and make myself invaluable for wanting to be hired by them ultimately.
Even though you were
intern,
an intern, right?
Yeah, exactly. And just sort of putting myself out there and not really being sure of what the outcome would be. I entered a training program, which was a 2-year rotational program, very formal, group of 20 or so college undergrads, good cream of the crop from all sorts of different colleges. They gave us 3 or 4 months of training, technical training, Excel, Series 7, Series 63. And then we were like just parachuted into different parts of the organization as like a jack of all trades help. And they held us in high regard there. So they sort of gave us a lot of leeway and opportunity to like forge our own path within a particular team, and we would rotate every 3 months. So got to see the whole organization, got to get exposure to the CEOs, to the low-level employees, and everyone in between. And then at the end of 2 years, you sort of looked in the mirror and said, what did you like, what didn't you like about those 8 or so rotations, and try to see if you can get a job permanently in one of those roles, and they would call that placing out into one of those roles.
Do you know if that program still is around?
Yeah, it's called the Graduate Training Program at UBS Wealth Management. Wealth management at UBS is like the core, multi-trillion dollars of assets around the globe, and it's a pretty prominent wealth management program. It wasn't investment banking where we were Excel junkies, PowerPoint junkies for 2 years working on big M&A or IPO transactions. It was much more management oriented or organizational oriented around wealth management as a business, not even necessarily just managing client assets one-on-one. It was, you learned A to Z of what that organization looks like. And then you get to, be full-time in one part of that organization. And I chose that derivatives. I did sales and trading role after.
So you ended up choosing that. What are some of the other things that you saw as you cycled through the different parts of the organization?
Well, I think the hardest or the most interesting thing for me was, and the most valuable thing for me was like every 3 months I had a different manager. So you have to adjust on the fly to different personalities and different skill sets and different technical hurdles that you'd have to get up to speed on quickly. So that to me was a very interesting learning experience. And just as I got, through the program, 9 months, 12 months, 15 months, it became much easier to adjust to an individual quickly and then ramp up for the next 3 months and working with them. So that was one element. And then second thing was very quickly we got to see like a Fortune 500 organization and all the divisions and all of the workflows that it entails. Again, from like office of the CEO to the marketing department to the technology department, client-facing roles, compliance, operations, and we just got to see all that and understand that now in terms of how I think about investing in startups and helping founders build companies in terms of like how they need to prioritize building the elements of the organization as best as as most responsibly as possible. So I have a good sense of what a Series seed stage company needs, what a Series A stage company needs, what B, C, and D, and then like ultimately can even envision taking a company from seed to IPO and sort of how an organization would need to be built.
So
that.
Right. So you were at UBS for 12 years.
13 years, yeah.
13 years. From when you were 22 to 35 approximately, am I correct? Mm-hmm. That was like most of your life at that point, that you were at this company. Did you get married in that time? Did you have kids in that time?
Yeah, so met my wife actually before I started UBS. So when I was a senior in NYU, we met, we dated a bit, broke up, got back together 25, 26, right in the meat of that job. And then we were married in 27. So again, like right in the meat of my sales and trading job. Remember the night of my wedding, the night before the wedding, I actually went out we went to see a movie as a team of coworkers with our coworkers. We would go to a movie every like quarter or so. It's a team building exercise. And I saw a movie with them, Prometheus, which was amazing, the night before we got married. And then the next day, yeah, the wedding, but was just such like a difference of days
Scenery.
of scenery. Yeah. And then a honeymoon and such. And then I moved over to the next role at UBS when I was about 31 or 32, which was much more entrepreneurial as a financial advisor, trying to build my own book of business.
That's like your own team at the company?
Yep. And eat what you kill compensation model, which is different than what my salary and bonus was. So, I mean, I can go weeks without making any money. I can go weeks with making a lot of money, but it was not predictable. And then had a baby, or had twin girls in the middle of that, and then straight into COVID. But I mean, I guess the other nuance is like my wife, Leandra, is an entrepreneur, and I married an entrepreneur, and I knew she was an entrepreneur from the onset, and I was attracted to that, I guess. So we were always, before kids especially, working our tails off during the day and even at night, right? And she did a lot of travel independent of me, and I traveled with her for work, and which was cool. So we both had like a 2-worker household from the onset, from when we were dating through when we were married, and then into having kids. So
And into today, right?
Into today, absolutely.
Right. So you were at UBS, and before you switched into the wealth management role, and you started building your own team over there, you were in the sales and trading role for that entire time period?
For about 5 years. So
Why did you switch?
2 years of training, 5 years of sales and trading, and then about 5 years or 6 years of wealth management. I actually, I'd been done 5 years of sales and trading, and I was one of the younger ones on the desk. Ultimately, my conclusion was like, can I envision myself in being my boss, right? In 20 years, 30 years, like, would I want an outcome that he has? And that was like the ultimate decision to make. No, I do not want to become that person or have that lifestyle.
That's a good way to think about it.
Yeah. So I said, okay, I'm gonna transition sooner rather than later. Even though I put a good amount of time, probably put 1 or 2 years extra than I probably should have ultimately, but no regrets. And so I looked across the street, across the industry, finance. I actually entertained maybe thinking about taking an operating role or working in a real business, an operating business somewhere. And I really thought hard about like what I would need to continue to build my skill set generally, and just continue to grow as a person and as a business person. And ultimately I said, wait, I'm actually covering, from a work perspective, my clients are financial advisors and clients of UBS, really wealthy individuals. And I saw that skill set, those financial advisors, and that what they were able to do interpersonally, to be able to win the confidence of all their clients and the money of their clients and be invested on their behalf. I thought that was really, really special in terms of like a skill set to have. How to win friends and influence people, or what was Robert Cialdini's book of Influence. Like, just, I think the concept of being able to, influence individuals, or I don't want to say manipulate, but have people that sort of buy into what you're doing is invaluable across anything you're doing, right. Sales, right? So I said, okay, I'm going to step out of my comfort zone, go into the role of financial advisor, which technically speaking, I can like do in my sleep. I knew what these guys did, and I was obviously familiar with the firm at UBS, so I can like plug into the organization really easily and take advantage of that, and try to start building my client list up from scratch. And that was, it's a blur at this point, but challenging. Just literally putting names on the paper that hundreds, and Syrian community is great because we just know a lot of people, right? Everyone at a wedding, you sort of, maybe they're not your friends, but they're acquaintances, and you know someone that knows someone that can get to someone, right? So I started building a list of individuals. I could envision the Excel spreadsheet I have now, and like just start reaching out. Breakfast, lunch, dinner, coffee, conversation, and just email exchange, text exchange, and just go down the list. And over the course of the first couple of years, start trying to build, try to convince or try to convert those individuals into becoming clients of mine and UBS's, and ultimately getting their the ability to for them to give me money to invest on their behalf.
So the sales and trading role was creating products that the wealth advisors, wealth managers, are going to invest their clients' money into.
Yep.
The wealth manager's role is just sales, pretty much. I don't want to say just. I don't want to boil it down to nothing. But I don't want to understate it. But is that really the crux of the job?
So the firm and other firms want to make it that just become sales for the advisor. They want to make it easy for the advisor to pick a stock, pick a bond, pick a mutual fund, buy a product, do a financial plan for a client, estate planning and the like, and they sort of house all of those technical nature of that in the home office, right? That's where the cost structure is, and they want the advisor to be out there bringing in business in a sales role. The better advisors are technical and good at sales.
That's what you are.
Somewhat, yep. And then you have advisors that are massively successful that if you got into their workflows and followed them on a day-to-day basis, were never behind a screen, never in the office, and just like really, really good with people. What would you call that? Sales or networking junkies, or I don't know what you want to call it. But I mean, ultimately, if you like had to grade who was really good and in terms of the money they made, they will like chalk it up to their sales skills. Because if you were a good trader, or if you were a good stock picker or financial planner, you'd be doing that as a specialty in a different organization. If you're an amazing trader, you're doing it at a hedge fund, right? Where you can get 20% of returns and 2% management fees, not the model that UBS or the wirehouse is built. If you're a great financial planner, you can have like a dedicated financial planning practice at a pay for advice type shop, right? If you're an amazing estate lawyer, you're doing it in a private practice at a bulge bracket law firm. So, as a financial advisor, you sort of had to be a jack of all trades, but ultimately it was contingent on the network you were able to build and the ability for you to onboard clients and attract their money.
So when you were around 30 years old is when you switched into the wealth management role?
That's right.
Was that, I often talk to people, business people, entrepreneurs, and they say, and their switch was from a corporate role into a totally 100% entrepreneurial role. That happened for you a little later, but switching internally within the UBS ecosystem to a different division, was that something that, I know you said that you delayed it by a year or two, which maybe you shouldn't have, but is that something that you took very deeply and you really thought a lot about? Was it less of a, life milestone decision?
Yeah. No, I actually was hesitant to stay at UBS. And I was looking at different roles at different banks. And like I said, different operating companies and industries altogether. But ultimately, I did a good job at climbing the ladder and winning favor across a whole host of people at the firm in different parts of the organization. Like I saw that my value, or maybe my skill, is that I'm able to, I'm likable, and I genuinely, and I've been able to build a lot of credit within the org. And how could I throw that down the drain and not want to leverage that when making, when taking the next step? So I wanted to have a compound.
So was the end game to stay at UBS for a certain period of time, just to it was just a
yeah. I could have been a lifer there if things worked out great, like within the wealth management role, or if COVID didn't hit, I very well could still be there and very happy with the organization. the business and the financial incentives of working at a wirehouse versus working at an RIA versus starting an RIA have like really shifted over the last bunch of years. So something technically or like structurally might have moved me over to a new organization. But I mean, UBS has only actually grown. I mean, they bought Credit Suisse, and they're really known as like the premier high net worth or ultra high net worth private wealth management shop now. So I very well could have been there and continue to build the business and a career.
So did you join a team or start your own team?
I started my own team. I joined I started my own practice alongside a Jewish mentor of mine that had a big practice at that point, just for like tips and guidance. So I'd work near his office and leverage his team a little bit.
They practice within UBS.
Yeah, within UBS. But ultimately, they were my relationships, my clients, and my way of investing, and I did that myself. So that was probably the first real entrepreneurial endeavor I took. It was a lateral move. It was a completely solo effort where, if I didn't want to show up to the office 5 days a week, I didn't have to go to the office. I had no boss. And again, what you kill, you make only as much money as you're able to produce, not by a salary and bonus.
It's cool.
So
it's
right in line with the entrepreneurial journey.
Right. Definitely a different type of role than what you were in previously. How does the partnership or the structure work with you and UBS? Like, are they paying you? Are you paying them a licensing fee for their name? How does that work? Are you using their systems?
You're an employee of UBS, so W-2, not 1099 or anything like that. And you essentially pay, or UBS takes a percentage of revenue that you generate, somewhere around 50%. But your employee, where you're getting like a base salary, that's minimal. And what's extracted from that are benefits, health insurance, 401k, etc. They provide you with an office to work out of, but again, like you don't need to be there. Computers, technology system, and for that, you pay them 50% of the revenue you generate. And
for their name.
And for the name, of course. And for the brand, which is important. So it's a pretty baked in model and works across all these firms for wealth management, at least. So I think 50,000 advisors under like a platform like this.
Oh, wow.
Nationally.
It's a lot.
From Goldman Sachs to UBS to Morgan Stanley to Merrill Lynch and everybody in between. And historically was predominantly stock picking and stock selling, which is what the Jordan Belfort days, evolved from. And then now it's predominantly financial planning and the sort of holistic wealth management advice.
You were in this wealth management role at UBS for 5 years.
Mm-hmm.
Did you grow a team or were you solo?
I was solo. So I had an assistant and continued to just hack at a way of bringing on as many clients as I can, generating as much revenue as I can, but as a solo practitioner. Wasn't at the point where I was able to consider partnering with another advisor or building the team yet. And then COVID hit, and it sort of just changed the whole trajectory of what a solo practitioner or financial advisor life and business is. But still very much in the early years of like building the business. So I was solo.
It changed the definition of what a solo practitioner business advisor is. What does that mean? Like, what did COVID really do to you?
What I determined was my business wasn't at scale yet. It was a lot of these financial advisor practices are on autopilot in some respect. They invest their clients' assets into a fee generating product where every month a fee is taken out from the client's account and paid to the advisor. And it's predictable. It's like a recurring revenue stream, unless the client leaves and the likes, but the clients are generally sticky. So my business wasn't at scale at that point. The recurring revenue of it wasn't a big enough number to it be a career. I mean, I was still like hacking away at trying to get commission and doing all sorts of different things. So when COVID hit, a lot of the clients pulled back from investing. Obviously, March 2020, April 2020, clients were extremely scared of what the markets were going to do as a result of the virus. And ultimately, like, the business dried up. I had the same amount of clients. I had the same dollar value of assets, but they weren't being charged the way they could be in a more stable market. And new client development stalled, right? You couldn't do any meetings. No one wanted to change advisors in the middle of this craziness. So that was like a big juncture. Like you weren't able to be out there to develop new client relationships, throughout the summer and then into the fall of 2020. So for me, I was working out of my bedroom downtown with my wife. She was in the bathroom. I was in the bedroom. We moved the desk into the bedroom. We had twin girls, year and a half year old twin girls in the other room, crawling around the apartment. And we were expected to be working all day, like 9 to 5, essentially having the same conversation with the same person, the same client, day after day to try to just sort of walk them off the ledge of the nerves and the anxiety that they had during COVID. So it was a lot of just like therapying individuals and not getting the opportunity to actually trying to generate dollars from the assets. And then again, was not out there meeting new people because it was COVID. So that like things just stopped in their tracks. My wife too was running a business of 20 employees that went fully remote. Advertisers pulled their dollars instantaneously. We had to lay off some people, and it was doing that all from the bedroom in April and May of 2020, which was crazy. And then at the same time, I had started doing a bunch of angel investing over the prior 5 years in conjunction with me starting as a financial advisor. What was really unique about being a financial advisor was like I was expected to be out there courting individuals, but I ultimately I found myself courting predominantly New York City-based entrepreneurs, startup founders that were building businesses in 2012 through 2020 in New York. And that was a really burgeoning scene that became like, it started from nothing and it started growing very impressively.
You were more attracted to that group?
So that's who I was generally trying to onboard as clients at UBS's because of the operating businesses and the ability for me. First of all, these are all people in my age cohort.
Sure.
Socially, I saw a lot of them because my wife was an entrepreneur in the in the media space. So we just overlapped a lot socially. And they were building real businesses that were starting to become venture-backed. Companies like Harry's and Glossier and Warby Parker and all these consumer businesses built out of New York that were venture-backed and that were the belle of the ball of venture capital funding at that point. And this is our social network and our cohort. So I ultimately tried courting them to become clients of mine and realized that I found more fulfillment and more value in learning about their businesses and potentially investing in their businesses, personal dollars. And I did that once or twice into an apparel business, into a skincare business. And very quickly, there was success with those businesses, whether it was the next round of funding from venture or one or two had monetization events, liquidation events, sold to bigger companies, conglomerates that become sort of like the poster child for this industry of consumer selling and direct to consumer more generally, and started investing even more personal dollars into these businesses. And Leandra would help them with some promotion and marketing because she had that platform and distribution, and I'd help them with just general advice giving and trying to find other sources of funding for them, which was sort of conducive to the network. And over the course of 5 years, as I was a financial advisor at UBS, building that business, I was also building this private investment practice on the side.
That's
on
cool.
the side, nights and weekends. Yeah.
So you were attracted to the startup founders to the point where you ended up actually angel investing in many of their businesses. Guys, there's a very good chance you found out about Momentum through Kosher Media. These guys are the premier advertisers throughout Jewish communities all over the world. Let me just tell you something. Momentum currently has however many thousands of listeners per episode. David and the Kosher Media team have been helping me expand my reach for over a year now. They have dozens of Instagram accounts with hundreds of thousands of followers, tens of thousands of contacts for email and text blasts, WhatsApp chats like there's no tomorrow. I mean, the list goes on. Whatever it is you're trying to advertise, a product, a service, a podcast, anything at all, call Kosher Media. It's an amazing experience working with them, and I promise you, you will not regret it. Guys, koshermedia.com. It's that simple, koshermedia.com. Tell David I sent you, and let's get back to the episode. As a venture capitalist with a fund investing in companies, you sort of have the leeway to go into a business, learn everything about it that you need to know in order to put the money in from your investors. as an angel investor, do you have those same respect? Do you have the same respect in terms of tell me everything and all your numbers and things like that?
Yeah, that's a great question. No, these are also super early businesses, startups. There's usually an institutional investor that's done a lot of the diligence before you or side by side. But no, I mean you're taking bets on individuals. I mean, we write a check for a lot of $1,000s into a founder after having a coffee meeting with them and just being bought in. They were going into fundraising. They were running proper fundraising process. They had a pitch deck. They had other investors that had already committed potentially, but they were looking to raise like a good sum of money that they were chipping away at doing successfully. And like we were, a brick in their wall. Like here's 10K, 15K, on their way to 2 million. Right. And a lot of those consumer businesses.
They took that 10K?
Yeah. So a good component of what we would do is like, there was a positive association, especially with Leandra and having her as an investor because of the platform she built. There was always an opportunity for Leandra and her employees to market that business in a disclosed way. But if it were apparel or skincare, like it could always just make its way onto the editorial page. If she's an investor, even more so.
For context, she runs a fashion blog, right?
She ran, digital media, started off as a blog, evolved into a proper digital media content site focused on fashion and female content over the course of like 2010 to 2020. Yeah.
She doesn't run Man Repeller anymore?
No, Man Repeller closed in 2020 during COVID.
Interesting. We should interview her too.
Pardon?
I should interview her too.
Oh yeah. She's been on hundreds of podcasts. So she has since started Substack in the middle of 2020.
So 2020 was a pivotal time for the both of you.
Oh yeah.
You were moonlighting the angel investing, so to speak, nights and weekends.
Uh-huh.
At what point did you say, I mean, was it COVID? Was COVID the point where you said enough with the wealth management, I'm going all into the investing?
So what COVID really did was no one moved. Everyone was on Zoom. And you'd pack your schedule on Zoom from 8 a.m. to 5 p.m. Like, as a concept, having a full schedule did not exist, in my opinion, until COVID.
Because there was no travel time.
Every half hour, I would have a conversation with someone, whether it was a client at UBS or someone I was being pitched, a founder I was being pitched a company for, or a fellow investor that we were considering investing in together. And COVID enabled me over the course of 6 months to have thousands of conversations, predominantly with founders and fellow investors, to build a whole network of co-investors that I had, like, that just came through email and came through referrals and the likes. And in December 2020, when I ultimately left UBS, I had spoken to thousands of people across venture capital and private equity and consumer investing and founders over the course of that time, and was at a position where, like, wait, I can, with this network that I was able to build during COVID on Zoom, leverage that to potentially start something on the private investing side. So I left UBS, not sure what to do, completely, like, there was no job on January 1st of 2021, no compensation, no salary, and wanted to figure out how to start going investing full time, whether that was going to be a fund or running a bunch of SPVs or, I don't know, co-founding a business and sort of investing alongside a co-founder. And over the course of 2021, figured out that the fund structure, Center Street Partners, and investing in early stage venture capital was what I was going to do. And I went out and raised capital to do that over the course of 2021 and closed on the first capital in October and got off to the races.
From January to October,
yeah,
there was a lot of uncertainty.
Yeah, tons. It was all black hole. I did not remember any of it. It was just.
What were you doing during that time?
Behind the desk at home now, with the kids in school, thankfully. Again, continuing to work out the network, searching for deals to continue to invest in. It was a very hot market from an investing perspective. Probably the worst investments made at any point were made January through December of 2021. So the buzz around in markets were crypto. It was private investing, like, the who's who of both consumer and
That
technology
was the Wall
companies.
Street Bets time. Also,
Wall
no?
Street Bets, right? That was, I think that was, yeah, I think that was 2022, early 2022, if I'm not
January
mistaken.
2022,
Yep.
maybe, right?
But like all in the same, it was this was the zero interest rate. What they call it?
Free for all time.
What was the Wall Street Bets? You got those checks, right, in the mails.
The stimulus checks.
Yeah, the stimmies or whatever they would call them, right? Stimmies.
Yeah.
And people were like just traveling. If you were single, you were traveling and going to Miami and you just living this like weird COVID single life. And it was this weird age. So had the whatever it was, it gave me the confidence and the gumption to go out and like go fundraise. And fundraising wasn't impossible during that time either. Like the clients that I had been working with, the markets were up at that point. Sentiment was high. People had cash in their pockets, and they got very good reception to raise a venture fund based on a lot of the stuff I had learned in the early stage consumer practice and the access we had to be able to do that more formally as a fund, and I did that.
When you're investing in a business, I don't know if you can share.
Yeah.
Around how much money are you investing per business, and what percentage of the fund is each company? A lot of times,
Yeah.
A lot of questions to throw into one, but just things to think about.
Yeah.
I think maybe it was in Peter Thiel's book, or one of these venture type of figures, that the strategy for venture capital is to invest in a lot of companies, right? And every company should have the potential to outsize the entire fund with their returns. It sounds a bit like a lottery. Mm-hmm. Am I correct?
Yeah, they call it the power law. Power law. A typical venture capital fund will have 30 companies invested in, and sort of, let's call it equal increments. Same check. So $1 million, well, 30 companies. Generally, pre-seed and seed stage companies raise between $500,000 and $4 million for the first money into the company.
And that's usually with multiple investors.
Usually with multiple investors. So we were investing $500,000 checks into something like 25 businesses. And the expectation is that in a portfolio of 25 businesses, 70 to 80% of those companies will not return any dollars. And the balance of those companies will return the bulk of the fund and hopefully a multiple of those funds. We're targeting 5 times over the course of 10 years, 25, 30% IRRs. So we need 1 or 2 winners to have grand slam outcomes. But the expectation is most of those companies will fail. And pretty quickly too. Like within 2 to 3 years, the founders will be onto something else. So
how do you remove the emotion from a company failing? A company that you put in $500,000 into failing?
We know that the power law and like this law of large numbers generally is what the data has been showing for a bunch of years. Mind you, my strategy now, and has been over the last couple of years, should have shifted to be much more control-oriented investors, owning majority of businesses, and for that matter, cash-generative services businesses, which can talk about where we feel like the real value of AI will compound over the next decades. But coming from venture and like understanding that economic model, the goal is to chat with as many founders as possible and to try to build that portfolio of 30 companies, 25 companies in a way that diversifies you from like a category component perspective, from a founder style perspective, but also from the perspective of like just giving you the best shots on goal to be able to get as many of those 25 to 30 companies to return money back.
So at this point, how many funds have you guys run?
We're on our second fund now. The first fund was a $16 million fund, actually anchored by Jan Koum, the founder of WhatsApp, who's been a fantastic supporter of ours. We invested in 25 companies and it's doing exceptionally well. From AI software through defense and national security, internet, media, fintech, healthcare, and everything in between. And now we are starting to invest out of our second fund, which is a $60 million fund focused on taking considerably less making considerably less investments, actually 12 investments in the portfolio, 3 of those businesses being majority owned cash generative services businesses. So these are not typical technology startups. These are businesses that have already existed in some instances for decades, being run by operators and founders that are sort of looking to move on to new life and sell their businesses to us, and where we then impart both talent from a venture network and software and AI that we've been exposed to in our venture network.
Sounds more like private equity.
It's a little bit more private equity oriented, yeah. Sort of a hybrid of venture capital, private equity, and the search fund, if you're familiar with that.
What's a search fund?
Search fund is when usually an MBA student or a post-MBA student will go out and raise capital with the intention of buying a company, but not knowing what company he's going to buy yet or what industry he's going to be in. And he'll successfully raise capital, or he or she will successfully raise capital from their network to back him to then go out and buy an operating business and then run that operating business, like in a more private equity type manner. But it's sort of just betting on one individual and like, here, go fish.
Interesting.
Yeah, it's a pretty popular model within the MBA world.
Cool. I guess you have to have those credentials in order to people to trust you like that.
You generally have a little bit more experience, and your network is bigger,
Right.
and you might have a little bit of an advantage on like what category or what business to go after because of maybe your business school experience or something else.
Right. So, where'd you get the money from? How'd you raise the money? Was it all network of previous wealth advisory clients?
Predominantly, like I like to say, like everything sort of built up on itself. I moved over from derivatives, which was not client facing, to wealth management, which I was, building client facing nature from scratch, to then venture capital, which was like purely fundraising and client facing from that perspective. Like it sort of just built on itself. And yeah, I mean, I had a whole Rolodex of individuals to court for the fund. Venture capital as an asset class is considerably more institutional than it ever has been. So there's also a whole host of fund of funds and pensions and endowments and all sorts of different organizations, family offices
is that a new thing?
that are more and more
and pension funds going into venture for capital.
Not new in the last 15 or 20 years. It started with Yale and Harvard and a lot of these endowment models,
Right.
quote unquote, that are a good majority private equity or venture capital. Versus public markets. So there's a whole world of organizations that are investing in venture capital funds, private equity funds, and early stage too, really early stage stuff. So we just sort of, again, mined the network and started building, taking that muscle memory of being out in front of individuals for the UBS role and trying to apply that to institutional investing.
Take me into the timeline of raising money and investing that money into a company. Is like, does the fund close before you make the first investment?
Yeah, you're building the plane as you're flying it.
Oh, yeah?
Always. So the what's interesting is like, the goal is to get to a first close with any fund raise for a fund. So try to get as much money as possible of investors to commit to a first close. And once you do that, you have then the money to start investing.
What's a first close?
A first close is when, so the way the typical fund life works is it's usually a 10-year life. The first handful of years you're fundraising and investing together. And then over the course of the life, the company sort of just live and you support them. But in the beginning couple of years, you're usually fundraising and investing together in unison. The first close is like you could actually raise capital over the course of 2 years. So I could take your dollars and I could take someone else's dollars 6 months apart, but it's actually investing into the same fund and into the same assets. So, and I could just do that incrementally over a rolling basis. The goal is to try to get as many clients as possible and do that complete fundraise as early as possible in the process, so you know what you could be investing in.
I guess because it's all private.
Yeah.
The returns aren't realized for until every round of capital is raised.
Well, the returns aren't realized until there's an exit or a liquidation event, but you can mark up or you can change the price of those assets based on when a next fundraise is raised. So it works a little bit differently like that.
Tricky technicality question now.
Yeah.
So let's just say that there's you're raising money for a fund, and company X wants to you're investing some of the fund money into that company, at a $10 million valuation, right? And then you sign me up, you invest in that, you do that, right? You put the $10 million, you put $1 million for $10 million valuation, you get 10% of that company,
Yep.
company X. 6 months later, I want to invest in your fund. The company X just raised money at a $20 million valuation. Am I retroactively part of that investment since it's in the same fund? You know what I'm saying?
The short answer is yes. The long answer is there are ways that enable the fund managers, myself, to compensate prior investors or earlier investors for a later investor getting access to an earlier price.
Interesting.
And usually the later investor will pay interest to the earlier investor in some proportion to sort of compensate them for that. In some instances, you don't usually offer two different prices of the same asset to different investors. But in some instances, you can like split the fund into two and have an asset here worth X and have an asset here worth Y. And you can have like sort of these parallel funds. But generally, like there's a sort of an interest charge that the later investors will pay. That's the goal for us. Like, why have this uncertainty or technicality that we would have to potentially implement? Like, the goal is to, and what we're doing is get as many investors or all the investors up front day one and want to buy in and have the demand for that fund as early as possible. I mean, I think that the nuance here is like, we can't just raise infinite amount of money, or it's not prudent to raise infinite amount of money for a fund too, or for a strategy. Like, we're hard capped at $60 million because we know that we can make 3 investments over the course of 3 years, one a year, based on the time constraints and the work adjusted constraints that we need to implement. And that where we see value is in this like $1 to $5 million of EBITDA range for a company, right? If we were to raise $1 billion, we couldn't buy $1 to $5 billion EBITDA businesses. We'd have to, put more money to work. And
EBITDA for the regular viewer, for all intents and purposes,
is profit.
Revenue,
profit. Yeah, you'll learn that next week. We're buying profitable businesses. So like, there's a constraint on how big the fund could be based on our strategy and the fact that my partner and I and my colleague Rachel, like we're 3 people. So we sort of limit ourselves to a certain fund size to execute on the strategy as best as we can. And then the next fund, we can sort of shift the strategy or shift the focus on the scale of company we want to go after and increase the fund size and raise more money.
So in the beginning, we spoke about how it's really all in the individual. You're betting on an individual as opposed to an idea. If you had to like break it down a percentage, what percentage are you betting on the individual? What percentage is the idea? What percentage do you think it lies in the execution?
They're not mutually exclusive. So it's the individual first and foremost. The individual, the founder, comes with an idea, usually in venture capital. So we assess their capability to be able to execute on that idea. We also assess their capability just generally based on past performance of their execution ability. And then we only know their actual execution ability once they're in the business and building it, founding it. So there's always room for error there that, on paper, the founder had an amazing resume and perceived ability to execute. They also knew the industry inside out because of their press work or their advantage. But guess what? Well, they're not a good hire, or they're not a good leader, or they made poor business decisions for whatever reason, and then the outcome is not positive. But I wouldn't say like I can divide it in. It all works sort of as a pyramid in some respect, but the individual is like the base layer of the pyramid. The founders and our perceived ability to assess them and their capability, in conjunction with their earned insight into being able to win a category and their execution ability once they start building that business. So sorry to not answer your question directly there, but it's all one big meal that they're baking and
it's
one big
holistic,
thing.
Right?
Yeah. What's interesting about our strategy now is like we're buying cash generative services businesses from operators or founders and not expecting the operators or founders to be continuing to build those businesses. So we're actually sourcing talent through our network that we've been through and through with and placing them into these businesses. And in some instances, actually like selecting the business to buy together with this talent. So it's a bit of a dance where we're expected to attract talent, expected to assess talent and their capability to actually execute on this buy strategy. And it's a bit nuanced a little bit more nuanced than venture capital, and what we've been doing in the past, but
I know labels.
Iteration.
Labels can labels can get like can oversimplify things, but at what point do you start calling yourself a private equity versus a venture capital fund?
Right
when
there.
you're do you have to buy the entire company in order to be considered a private?
Yeah, there's no technical difference there. I mean, venture capital is just a subset of private equity. Ultimately, it is private business.
Right.
But we're actually creating. My partner Jonathan and I are like extremely innovative in the respect that I believe we're creating a whole new asset class. It's a hybrid asset class. It's at the Venn diagram in a lot of ways where we're going out and raising money. Like, wait, what box do we fit you in? You're not venture capital. You're not PE. Like, how do we pitch this to our investment committee? Like, we can't think outside the box like you are. And we'll walk you talk you through this new strategy we believe is differentiated.
Right.
Pardon? I mean, right? Like Steve Schwartzman at Blackstone was doing something different in 1988 when he was building Blackstone and the first hedge fund. What do people think about that? Right? Wait, so you're not just telling me to buy a single stock. You're actually like putting it into a bunch of stocks into a portfolio and like gambling on these businesses. So we think we're forging the path to create a whole new category, and hopefully we can succeed at that.
Take me into the early. We talked a lot about the technicalities of having a venture fund and everything like that, which I'm still interested in and I want to talk more about. But let's get back into your story for a second. Take me into starting Center Street Partners.
Yep.
How'd you find your partners that you started it with, and what was it like in the beginning?
I'll start with the name because I think it's a big part of it, or important component of it. Leandra and I lived on Center Street, 221, for 5 years. COVID towards the tail end of it. So a big part of our
where is that? Which neighborhood?
It's Center and Grand, so it's just south of Houston. Obviously, it's north of Canal. It's sort of like right in between Chinatown, Nolita, and Soho. It's really like the pinpoint there. So you get a bit of the old world, new Nolita, a bit of the new world in Nolita, and it's sprouting over the last 15 years, and then Soho, the famous Soho. So, but not a particularly residential area, but a very New York block. And Center Street is famous for being one of the original streets of New York City. All the courthouses are on Center Street if you go south. The marriage house is on Center Street. So, and it's spelled the English way, CENTRE, both Center Street in New York and our fund. So I stood up that name as like a holdco back in 2017 when we started angel investing, as being like just a sort of a brand for founders and the ecosystem to potentially know us as something more institutional, not just Abie Cohen on the cap table, but Center Street Partners on the cap table. So stood up a holdco or an LLC and started investing out of that, and did a lot of the bulk of the investing, and then started building a bit of a brand online or on LinkedIn with respect to that Center Street, and then said, okay, that's going to be the name for the fund or the firm now, and just sort of segue that. And that was all done before I had partnered with my partner now, Jonathan Kirstein. Jonathan and I had known each other for better half of like 3 or 4 years prior. We were introduced to be a very close mutual friend who was a private investor at a family office, and just thought we'd get along. Jonathan has a very interesting career. He grew up in the Five Towns. His dad actually went to Flatbush, which was interesting, a bunch of years before me, but I thought that was a nice, good root of a relationship. I hold Flatbush in very high regard generally, and anyone that went there. And he went to Baruch College, super smart, but went to Baruch, so not unlike a lot of the Syrians. And then made his way over to a firm called Insight Partners out of Baruch, which is very rare. That's like, not going to college and going to Goldman Sachs, right? And getting a startup job or analyst job at Goldman Sachs, having not done college at all. That's, that doesn't happen. Like, you usually go the track and you'll soon learn. Stern is a career services center. You got to get a sophomore internship. You got to get a junior internship. You get placed in, sort of what I did, right? And what most people do. The better college you go to, the better shot you have at going to these institutions and starting on the training program. But Jonathan got into Insight, which is an $80 billion venture capital private equity firm based in New York City that's done huge private equity and venture capital transactions. They have a buyout practice system where they go out and buy public companies and take them private, and also go buy large software businesses, technology and software businesses, and take them and sort of become majority owners of those businesses, which is a good foundation for what our strategy is right now. So he did that and started 3 years at Insight. We had been getting to know each other really through COVID, like I mentioned, like with the investors that I'd gotten to know, and should do a bunch of deal sharing, do a bunch of co-investing together, both as angels predominantly, and built a relationship up. And I started Center Street alone as a solo practitioner again, with the intention of finding a partner, especially coming out of my experience at UBS, where I realized like I needed a partner to really succeed in that role. And started the fund, raised a bit of the fund, started investing. And then January 1st, 2022, the whole market turned upside down. Whatever happened, there was a vibe shift, major, whether it was coming out of COVID or what. But the market turned upside down, and venture was a hard asset class to be investing in. And Jonathan and I were catching up over coffee, which was supposed to be about like a half-hour conversation that turned into a 3-hour lunch, and seeing eye to eye quickly on like what a potential partnership would look like at Center Street. So we went the next 6 months. We didn't jump into a marriage then, but we went the next 6 months at like deliberating what a partnership would look like. Him leaving in Insight, what kind of strategy we would implement, strategizing about going out, raising additional capital, having to negotiate a partnership with a fund that's already off the ground.
So you dated for 6 months.
And we dated for 6 months. But like while I was flying this plane alone and building it alone. And then we did that in August 20, we finalized that in August 2022. And we went back out to fundraise, shifted the strategy, increased our check size, the portfolio construction math changed. And we've been doing that as a partnership since. And it's been great. So it's 3 years at this point. And we closed on additional capital, got Jan Koum to invest from WhatsApp, and did a close on the fund, a final close on the fund where we raised our last dollars in May of 2023. And again, I've been investing since then. So, and we're doing Fund 2 together. We're partners, we're practically brothers. And it's been great. So.
When I started Momentum, I did it because I love talking to business people. I wanted to inspire people with real stories of how people built something from nothing. But what I didn't expect, not in a million years, is how much those episodes would mean to the families of my guests. I've had people reach out to me and tell me, Victor, I watched my dad's episode 3 times. Thank you for capturing a piece of him forever. And that's what led me to start Life Vault Films. Guys, it's a way to professionally capture your parents or grandparents or your full life story, from where they were born to how they built their life, their family, their values, their business, all of it on film forever. It's not a tribute, it's not a slideshow, it's them telling their story in their own voice so that your grandchildren and great-grandchildren can know them too. I mean, think about that for a second. Imagine that. Imagine you felt like you knew your great-great-grandmother. Wouldn't it be amazing to see her smile, to hear her voice, to listen to her talk about her life in her own words? And that's what Life Vault Films gives you. And it's something your family will cherish for generations to come. Guys, if you want to capture the essence of your loved ones forever, click the link in the description to learn more. Because if there's one thing I've learned from the podcast, is that stories fade unless we capture them. Let's get back to the episode. If you had to estimate how many startups have pitched you?
5,000.
And how many investments have you made?
Between personal and fund, probably about 100.
Wow.
Yeah. Very low hit rate.
10, half a
Yeah.
percent, half percent, whatever.
Yeah, whatever it is.
0.1%.
Yeah, I would say I've seen 5,000 companies. I've probably been pitched 2,000 or 3,000 times.
Right, formally pitched, right?
Yeah. Very low hit rate. Seen businesses from ideas on a napkin through later stage of businesses as well. seeing a ton of pre-IPO stuff right now, and everything in between, from AI, software, fintech, internet, healthcare, media, crypto, hardware, defense, like you name it. The market to be an entrepreneur right now is really healthy, especially in America, particularly in America. So we try to get our hands on as many opportunities as we can and try to assess them in a vacuum.
So what does the landscape look like? Maybe it boils down to the time period. Maybe it boils down to the players in the game.
Yeah.
But what does the landscape look like between VCs and startups?
Yeah.
Like, are the startups chasing the VCs' money, or, and I've heard this many times, and tell me if it's true, are many VCs trying to get into a few startups, and so it's competitive for the venture capital funds?
Yeah. It's both. And again, the vibe shift that I had mentioned that started in 2022, which was mostly a function of VCs trying to get into, pre-2022, there were a lot less VCs, there were a lot less startups. VCs were trying to get competitively into fast growing startups, in a way that bid up the price of these startups, and the founders would be able to raise at higher valuations because they had a lot of demand for their product. In 2022, things shifted. Money was taken out of the system. VCs now had the power back in their hand to demand to name a price, or to name the price that they wanted to invest in, and pass on tons of startups that they felt didn't reach their higher bar of quality. And then since ChatGPT, the AI race was created, it started, and it's considerably harder to get into better companies. Venture capital getting into better companies is harder because there's a lot more power in the hands of the founders than there is in the investors. So it sort of shifted dynamically over the last bunch of years, back and forth and back. And I would say generally, like, for the perceived higher quality founders, better pedigreed, more technical, there's a lot more demand for those companies. And there's a sort of a game that gets played between venture and different cohorts in venture, and trying to get into those businesses and getting in at any price.
Right.
Just to get, bid up to that next level, that next valuation. And then there's a whole subset of other companies that are struggling, and where venture capital is not interested, and whether it's an asset, whether it's a sector that's out of favor, consumers generally out of favor now, as an example, or it's a founder profile that's just not appreciated by the market. Everything that you would go into in assessing whether or not an investment should be made or not, it gets assessed at this point. And there's a whole cohort of thousands of companies that are just not being funded, and founders have to choose a different career. So it's all healthy and part of the capitalistic nature of the system, and what sort of works itself out always.
So we discussed the personality and character of founders, and how important those are to whether or not you make the investment. If we had to pinpoint a couple of hard skills of investors, of founders, excuse me, of things they could have on their resume, or things that, abilities or skills that they can acquire to make them more desirable, do you have any that you could pinpoint?
Yeah, I mean, especially on the early stage, pre-seed and seed, like prototype of a product is integral at this point. Like, very few people are just investing on ideas or decks without a tangible product to speak to. So ideally, that founder would have built that product themselves. How do they build the product? They either know how to code or know how to engineer, or they can vibe code, right? I mean, or work with the AI tools, the thousands of AI tools that have been created over the last few years on the back of the LLMs that enable the average person to be extremely more efficient, productive, technical in some respects when they weren't necessarily technical, and to show that they went from zero to something in short order and completely in an entrepreneurial or like self-starting way. Like, that to me is extremely important these days. I get asked all the time from guys like you and people trying to get jobs, like, what can I do to get a better job, or how can I be out there? I'm like, you gotta create something from nothing. Like, you gotta put your resume out there, create your own website, tell people that you built it yourself, even though you might have, gotten some help and stuff, but like really sort of iterated your way into building hopefully a first prototype of what you envision building. And that if that's software, if that's a hardware product, whatever it is, but there's got to be some foundation for why you deserve to be building that end product via how you're building iterations toward that product right now.
How much do you consider the school that a founder went to?
Very little. Very little. I mean, I could stereotype each school and the founder profile and what they're going to say the same question I ask. Like, I have 12 schools, and literally, like, I'll get the same answer from each individual. There's a Stanford profile, there's a Princeton profile, there's a Harvard profile. There's certainly a Harvard profile. There's always a Harvard profile. For some reason, you go into these institutions and come out saying the same exact things as the other individuals. It's really crazy.
So funny.
So schools, very little. I mean, there's a lot of publicity more recently on the Thiel Fellowship. I don't know if you've heard of that concept. Peter Thiel, obviously prominent, very prominent.
Peter Thiel.
The Thiel Fellowship.
Sure.
Palantir, Founders Fund, PayPal.
No, I'm saying, are you
First
talking
investor
about the
in
Palantir Fellowship or something else?
No, the Thiel Fellowship.
Okay.
So Peter Thiel in 2010, there was an article over the weekend that was published on this, started a grant-making organization called the Thiel Fellowship, where he would pay a college student to leave college and start a business. And he funded 20 students with $100,000 each, saying, college is no good for you. Leave all your hopes and dreams down the drain, disappoint your parents, disappoint the institutions, and start a business. He's since done that year over year. It's grown to thousands of fellows, and those are not college graduates. They're college dropouts that have started more unicorns than Y Combinator has started unicorns.
Really?
Yeah. So,
does he put them through a training program or just gives them the cash?
There's a network that gets developed around these Thiel Fellows.
Right.
There's obviously a massive interview and sort of assessment process that he's got a team of people doing at this point. But I think Palmer Luckey is a Thiel Fellow. I could tell you.
You think who?
Palmer Luckey from Anduril is a Thiel Fellow. Alex Karp from Palantir, I don't think is officially a Thiel Fellow, but like one of Peter Thiel's insiders for a very long time. That I think they're both at Stanford. There's a whole host of like famous founders these days that are Thiel Fellows that are college dropouts.
I can't believe I haven't heard of this.
Yeah, absolutely. Yeah. And then you've heard of maybe Y Combinator, which is a famous incubator or accelerator program in San Francisco that takes hundreds of founders a year. Some of them college dropouts, some of them college graduates, but they are very specifically like check the box on a particular founder profile, college, technical, product that they're building. And where Thiel's like, no, this is all bet on personality type and the sacrifice that he's making and leaving college and disappointing his family and standing out from the crowd and like going to start a business for that purpose's sake. So no, I mean like that's just an example of like, or a testament to like, no, we do not hold the typical profile as that important. But I mean, we back founders that have insane resumes. Our first investment in our fund two is going to be into a couple of founders that were West Point grads, U.S. Army Rangers that served in Iraq together. One went to Harvard MBA, one went to get his Wharton MBA, one went to Palantir for 10 years, one went to William Blair, focus on investment banking. Like these guys are resumed, right? They chose from birth to go to West Point. Like if you're that type, you're looking for the institutional route. And they're a fantastic team that are executing insanely. So it depends.
It's pretty cool.
Yeah.
Those are cool resumes.
Yeah, they were great resumes. I mean, anyone going to West Point, that's instead of going to Israel for a year, going into the Army for 7 years, signing up as an officer,
right?
Basic training, the whole 9 yards from high school. That's impressive.
That's pretty wild.
I'd love to hear if any Syrians have done that. Actually, I don't know of any, but we probably are very underrepresented in the U.S. Army.
I'm sure
a little bit less in the Israeli Army, but
right.
Yeah.
For a young person who wants to be in the position that you're in their near future, 5, 10, 15, whatever a reasonable amount of time is, what do you recommend they do in college, just out of college? What should they pursue? And how could they best set themselves up to be where you are?
I'm definitely an advocate of college generally. I just think you need a diversity of experiences in college, whether that's going somewhere and living somewhere that's not New York, or taking a whole range of classes to try to get a sense of what your interest level is and like what your passion is as early as possible if you can. So super supportive of that. GPA is still very important too. Note that, like in terms of just opening doors for you, like you have to have that minimum GPA to take you, for people to take you seriously. At least I ask a bunch. In the same regard, if you are a high school graduate and like your life's purpose is to start a company in XY category, like there's a lot of value, and I would appreciate that too. So I just say to get a diversity of experiences predominantly, like take your academics really seriously from the onset. And I think there's no past years, there's no years you can just skip. Freshman year counts just as much as senior year does, and try to get a sense of like what your working interests would be, and try to get that. Better to see that like over the course of college in terms of internships and the likes than just starting from scratch in 4 years. So multitasking, I think is the way I'd sum that up. Like, study, work, have fun too, but like do a bunch of stuff, and love to see people that are like able to take on a lot of tasks at the same time.
What do you think about the piece of advice? Follow your passion.
I'm generally supportive of that. Do what you love. The we work line. I think if you know what your passion is from elementary school, it's really cool. And
Lucky you.
And you should absolutely pursue it, even if it's hard and doesn't make much money. I'm generally supportive of people that do that. If you're like really there's a range of like experimenting too much with trying to find out what you like versus too little, and you want to sort of just be in the middle, but you want to just have, again, a diversity of experiences and have it come up in a story where you're being interviewed or where you're being assessed in some way where it benefits you. I mean, everything comes down to storytelling, and I think that's going to be an important part of trying to explain or try to convince someone that they should make a bet on you, because that's ultimately what you're going to need to be doing. But if you've done 50 different jobs over the course of 3 years, it's not going to be a good, unless you can spin that into a really interesting story. Like it's not necessarily going to be perceived well by people that need to make a bet on you. So
Right. We like to dedicate a segment, or at least a part of every episode, to giving back or to getting involved in things that are beyond business. Like I think for people who are striving for success, obviously monetarily, like it's measured monetarily, and that's all great, and I'm with that, and I'm part of that measurement. I sign up for that, but you have to have things that are beyond business in order to get you going and to give you fulfillment. What fulfills you in that way?
Yeah. I start off by saying that for a very long time, I felt like I was searching for a way to give back in a way that
wasn't just donating money.
Yeah, totally separate from money. With respect to time,
it's easy to throw money at things, right?
Charitable in some respect, and was struggling to find what that was. Some of them were Jewish organizations, some of them were career-related organizations. Ultimately, my best approach towards giving back is doing it on a one-to-one basis. And I could think of about a half a dozen people in my life right now that have become close friends that I spend a lot of time with personally, that I just sort of try to support motivationally or psychologically in different ways, and ask them to pay that forward at some point if they can. But there's no financial return, and it's just doing it from a place of innate intuition that these people need a little bit of me in their lives and different respect, and spend time with them to help them. So people from all walks of life, all genders, all ages, and someone I just sort of take to me, and we just sort of develop a friendship that maybe is a little bit more one-sided from the beginning, but then it evolves, and I learn a ton from them as well. And then a relationship sprouts. And sometimes we stay really close, and they're part of my life and I'm part of theirs. And sometimes we go our separate ways, but for that point in time in our lives, like we need to be there for each other. So, yeah, I don't know what you'd call that, but the textbook word is like sort of mentorship, but it's so much more. It's just being support system for people that just need a little bit of help.
Very unique, I have to say, very unique, especially as somebody who can, you can easily throw money at things and call it a day, but I think you like donating time is much more valuable than donating money, and much more personal, like you said, unique and one-on-one.
Sometimes those signs are like when people are asking for money, those are the people that need money the least,
Right.
and they need the support the most. And
Right.
that first test is, do you just make the problem go away and by throwing $180 check to them, or do you actually try to get to the crux of what their problem is and eventually see that they need some support elsewhere, and the money is just an easy way for them to ask for something.
Ask for money, get advice. Ask for advice, get money twice. Is this
Yeah.
true? Is it from the song?
I haven't heard that one, but
Pitbull.
is that right?
Yeah. It might be.
Yeah. Ask
might
for
be
advice,
a
get money
line.
twice. Absolutely.
It might be a line before him, but he's singing the song.
I love it.
It's
I'm going
good.
to listen to it in the car on the way home.
Yeah, I'll send it to you.
Yeah.
But okay,
Yeah.
cool. If you had to leave young people with one thing that they can do or skill they can develop over the next 7 days, what would that be?
Oh my God, 7 days.
Tough. Okay, they don't have to develop it within 7 days, but something actionable that they can take into their lives, and not just be kind, not just be good, like network, like something that people can really do over the course of a little while.
Start meditating.
Interesting.
If I had to leave, if it's just one person asked me for advice, then something I could start tomorrow, yeah, pick up a guided meditation and try it. See where it goes. It's
Cool.
easy.
Cool. How long do you meditate for?
I do 20 minutes twice a day, and have been for a very long time. And life is very different pre-meditation and post-meditation. So that would be my initial instinct was to be like, continue to be curious or do some self-growth stuff, but this is an actual more tangible
Very tangible.
portion of self-growth. Yeah, like pick up a guided meditation app. Happy to recommend a million or some other modalities. And
What would you recommend? A couple apps.
Waking Up by Sam Harris is where I'd start. Also, Transcendental Meditation is great to start, which is really simple and easy. And then there's a ton of stuff on YouTube, but I wouldn't expect anyone to knock it out of the park with their first one. Just if you're willing to challenge yourself and sit down for 20 minutes with your eyes closed,
Tough.
peaceful, and like just try, like that is a big point of validation in my book that like that person's willing, that I should be willing to spend time with them, and that they're actually looking to help themselves. So.
It's difficult to do nothing for 20 minutes. Like, I don't know, like a hot take, and I think I'm saying what everyone's thinking, but
No, you could take a nap, right? You've taken naps.
totally different. Totally different.
It's very similar,
Really?
I think. Yeah.
I mean, I've never meditated before, so I don't know. But like, I'm like, just for me, whenever I have a free moment, I'm reaching for my phone.
Yep.
Right. And so, like, have you found that your compulsion to reach for your phone whenever you're free has decreased after you started meditating, or not really?
Overall, if you like have to make that like long macro assessment, yes. But I don't know if it's
Hard to measure.
I don't know. Yeah, I don't know if the stats that big, but like, you're one with your thoughts. You're one with your energy. You're one with your body, which very people get to feel and experience. You're one with your feelings, which is important to feel and let process. And also, the wildest ideas come up sometimes, where I have to stop what I'm doing and like take my notebook down and jot it down, or I have to reach out to this person. There's something calling me to touch this person today,
Right.
or I forgot the keys 5 years ago on my couch. Right, like the craziest stuff will happen, and then you'll
wild.
realize that sort of Hashem and the universe are working in different ways.
Very interesting.
Yeah,
Very interesting. Okay, meditate. Abie, I want to ask you for your momentum moment.
yeah.
It's sort of the moment where you gain momentum. That's really it. It's pretty simple. A lot of people jump to their biggest accomplishment, which is not necessarily that. It could have been for you the moment that you realized that you could make a business out of working for yourself, and it could have been COVID for you. I don't want to tell you what it is, but if you had to think of the most impactful momentum moment, what would that be?
It was way back when. This is 2010. There was my wife and I, at that point, Leandra and I were broken up, but we had gotten together for some lunch as a broken up couple. And she essentially gave me an ultimatum saying we could get back together or we cannot talk to each other ever again. And whatever was happening, I got pushed or influenced or whatever it is, convinced to, not by her, but by some other power to say, yes, let's get back together. I promise you, my head was shaking no, but my mouth was saying yes. And that was my momentum moment. I think it should change the trajectory of my life.
Interesting.
That was my momentum.
Cool.
Yeah.
Cool. Love it. All right.
So.
Abie, thank you for coming and for sharing your story. We got into a lot of technicalities about venture capital, private equity, the finance space in general. But I think that for the right viewer, that's going to be very helpful.
And I'm happy to answer any other specific questions, and feel free to share my info with your viewers to have them reach out, because I think I'm excited about who comes my way for both professional and personal reasons, and see where it goes. So thank you.
Cool. All right, Abie, thanks.
Thanks, Victor.
Awesome. Thank you so much for listening until the end of this episode with Abie J. Cohen. Guys, as always, here are my top three key takeaways from our conversation. First, bet on people. Whether you're choosing a co-founder, a partner, or even who to hire, the individuals matter more than the idea. I think we've heard this time and time again from Abie. Surround yourself with people who have great integrity, the ability to execute, determination. That's what determines success. Second, volume matters. Abie has looked at thousands of companies to make just a handful of investments. I mean, think about it. The same lesson applies outside of VC. The more shots you take, whether it's outreach, interviews, ideas, whatever it might be, the more likely you'll find the one that changes everything. And third, learn to build something from nothing. Abie said that today, investors want to see founders who can create a prototype or a product on their own. Even if you're not starting a company, showing you can take initiative in some sort of way, teaching yourself new skills, bring an idea to life, that's what's going to set you apart. 3 simple but powerful lessons to focus on people, increase your reps, and prove you can create. If you enjoyed this episode, you're going to love my conversation with Ezra Dweck. He's the co-founder of IceCap Group, which was actually a company that I interned by this past year. They're one of the largest private real estate lenders in the Northeast. And in that episode, he shares the story of how he lacked direction in his mid-30s with a wife and kids at home, and how that led him to start a huge lending business, which now lends over $100 million a month. Guys, check that out by searching Momentum Ezra Dweck on any platform, or click the link. It's in the show notes down below. And guys, wherever you're watching this, please make sure to subscribe, to follow us, whatever it is on your platform. We're on YouTube, Spotify, Apple Podcasts, as well as the social media, Instagram, and everything like that. Guys, be sure to click that follow, subscribe button. Our metrics show that a large portion of our viewers are not subscribed. And if you want to keep up with our weekly episodes, be sure you're followed, you're subscribed, whatever it is on your platform. I want to see you around. And with that, I will see you in the next one.